A common question that I hear is, how do I reduce my tax rate in retirement? The lower your tax rate means the less that you pay to the IRS, which means the more that you keep. So today we're going to talk about 5 strategies to help lower your tax rate in retirement. For example, let's just say you had $100,000 of taxable income. Your effective or average tax rate was 15%. Well, that's $15,000 in taxes that you're going to pay to the IRS. But if you were to reduce that tax rate to 10%, well, now that's only $10,000 that you pay to the IRS, which means $5,000 more in your pocket to do the things that you want to do. So today we're going to talk just about that. What are the 5 strategies to reduce or lower the tax rate that you'll pay in your retirement years? Now, I wish there was an easy fix for this, but unfortunately, as you know, there is no such thing as the easy button. So before we can understand how to lower the tax rate, we have to understand what causes that tax rate, which is taxable income. And if we're going to lower it, we have to understand, how do we reduce taxable income? Well, first off, I want to share with you what all goes into your taxable income. Once we understand more about this, it will help you understand more about the 5 strategies that we're going to talk about today. So let's take a look at this. What all adds into your taxable income? Well, that's wage income. Now, if you're retired, you might not have wage income coming in, but interest, dividends. Primary one that you're going to become familiar with in retirement is your IRA, 401k, 403b, or 457 withdrawals, the money that you're taking out of your retirement savings. Pension or annuity payments, those add into taxable income. Social Security, a portion of that could add into your taxable income. Capital gains and losses, and then maybe rental income that you have coming in from real estate, or business income that you have coming in. All of these add into your taxable income. The more taxable income that you have, the higher your tax rate goes. And of course, yes, there are strategies that we're going to talk about of how to lower that tax rate through your retirement. But a primary driver that sometimes people know about, but they just don't understand the impact of it, or they're not necessarily thinking about it yet and don't realize the impact of what's coming at them. And the primary one actually focuses around your IRAs, your 401ks, your retirement savings. Because at age 73, or depending on when you're born, maybe age 75, you're going to have to start taking required minimum distributions. All of those required minimum distributions come to you as taxable income. Remember, more taxable income, the higher your tax rate goes up. So take a look at this, just to kind of, again, giving you some knowledge before we talk about the strategies. Take a look at this here. This is based on the 2024 required minimum distribution table. And just to kind of give you an idea, so then you can kind of look at your accounts and go, wow, that's how much I'm going to have to take out in my future. So let's just say this year, a person who is age 73 had to start taking required minimum distributions. Let's say they had $1 million in their account. As you can see, that's just over $37,000 of income that they're going to have to take out, adds into their taxable income, driving their tax rates up. If that account balance was $3 million, that's $113,000. $5 million, $188,000. Another misconception is that your required minimum distributions will stay the same throughout your retirement. And that's a misconception here. Let's just say you had $1 million in your retirement account through retirement based on growth in your account. You can see that as you get older, now age 85 with that same $1 million, well, you're going to be forced to take out over $57,000 of income. Go down to that $5 million number. If you've got $5 million in your account, you're going to be forced to take out $287,000 from your IRA as a required minimum distribution. So that's just kind of providing a little bit of knowledge, right? Because we want to reduce our tax rates. We want to keep more money in our pocket versus giving it to the IRS. But it's based on how much income that you have coming in. That's what drives the tax rates up. So let's use this now to talk about the 5 strategies to help reduce the tax rates that you'll pay and keep more of that hard-earned money in your pocket. Strategy number 1 is Roth Conversions. That's where you take from your IRA and convert it to Roth IRA. Now, when you make that conversion, meaning you move the money from your IRA over to the Roth IRA, Roth where it's going to grow tax-free, your withdrawals are tax-free, you're going to pay tax today at today's known rate. Now, you might be thinking, wait a second, how does that lower my tax rate in retirement if I'm actually adding more taxable income to it today? Well, yes, while you're adding it to it today, but one of those things they have to think about, which I showed on the screen earlier, is those required minimum distributions. So depending on when you've retired, how much time you have between now and your required minimum distributions, by doing Roth conversions, you're now taking control of the tax rate that you pay. And if you're able to take control, convert some of that money over to Roth, it might mean that you're reducing the required minimum distributions that you take in the future, therefore reducing the tax rate that you might have in the future as well. So as you saw there at age 85, the amount that you'll be forced to take out is more than what you'd be forced to take out at age 73. That's what drives those tax rates up in the future. The Roth conversion can help you. Yes, you might pay more tax today, but over the long period of time, lower the tax rate and the overall taxes that you pay to the IRS. Now, I have a video specifically on Roth conversions and if you should complete them and should you start completing them while you're working or once you're retired. In regards to different amounts that you have saved up. So I'm going to include, you'll see a link above, but we'll also include in the show notes below a link to those videos specifically on Roth conversions and how those can help lower your tax rates in retirement. Now, for all of these, make sure that you talk to a financial professional as well as a tax professional to see which strategies are the right strategies for you. Number 2 would be qualified charitable distributions. Same, this is going to help lower your tax rate because it's going to reduce the taxable income that you have coming in from required minimum distributions. So for example, if your required minimum distribution was $50,000, well, that's $50,000 of taxable income coming in. If you use the qualified charitable distribution process and give $5,000 to a charity, now instead of $50,000 of income, since you gave $5,000 directly from your IRA to the charity, you only have $45,000 of taxable income coming in. You've lowered your taxable income, which therefore has lowered your tax rate. Now, if you're not age 70 and a half, this might not apply to you, but there are other ways to use charitable contributions to, again, lower your taxable income and lower your tax rate. Same on qualified charitable distributions. I have a more detailed video on those, how they work, and actually how they can reduce your tax rate. I'll include a link in the description below. Strategy 3 is shifting interest income to long-term capital gains and qualified dividends. You see, interest income, now this could be, interest would come from your checking, your savings, your online savings accounts, CDs. This could come from bond funds in your brokerage accounts, your trust accounts, your individual or joint accounts. Anything that produces interest. Interest adds into your taxable income, and interest gets taxed at your ordinary income tax rates. Now, I know I showed capital gains on the taxable income chart. However, long-term capital gains gets taxed at a more favorable rate called the long-term capital gains rate. And by making that shift, the long-term capital gains rate is lower than your ordinary income tax rate. So shifting funds that are now producing interest to funds that are that you can hold for the longer term. So you'd have long-term capital gains if you were to sell them, or they're producing qualified dividends. You're now shifting those funds then into a lower tax rate. by making that shift, you're now lowering your overall tax rate as well. Now, before I get into strategies 4 and 5 of how to reduce your taxes in retirement, I do recommend that you download our guide to unlock hidden tax savings opportunities. You can get it at lifemoneyshow.com/taxes. We'll include a link in the show notes below. Again, lifemoneyshow.com/taxes. It's a guide that's going to give you actionable items to help you potentially lower your taxes that you're going to pay to the IRS, meaning keeping more of your retirement savings with you versus paying it over to the IRS in taxes. lifemoneyshow.com/taxes. The fourth strategy is using municipal bonds or municipal funds. As we talked earlier, interest adds into your taxable income. But when you use municipal bonds or municipal funds, the interest that those pay off is considered tax-free interest. So if you're in a higher tax bracket and you're looking for ways to lower your tax rate, you can take and shift anything that's producing normal, ordinary interest and shift it over to municipal bonds or municipal funds that then provide you tax-free interest. Now you've lowered your taxable income, therefore lowering your tax rate. And then our fifth strategy comes to how you're withdrawing your money in retirement. Depending on where you've saved, you might have some money in what they consider the taxable bucket. You may have some money in the tax deferred bucket. That would be your IRAs, 401ks, 403bs. And then you might have some money in the tax-free bucket, the Roth IRA, the Roth 401k. Now, depending on how you pull the money out of those different buckets in your retirement can depend on what your tax rate will be in retirement. Also, you have to think about those IRAs, 401ks, you'll have the required minimum distributions starting at either age 73 or age 75. So if you're in a lower tax bracket prior to those ages, it may make sense for you to then start taking money out more money out at ages prior to your required minimum distribution age. Again, because you're now taking control and managing which tax bracket you're pulling that money out in. Now, if you're really considering something like that, then you should kind of go back and listen to strategy 1, because it might also make sense then if you're not going to use all of that money to convert some of it to a Roth IRA. So this is something that you need to think about. I do have a video specifically on this as well that we'll link to in the show notes below so you can look at and understand withdrawal strategies when it comes to your retirement. But putting together a proper withdrawal strategy can help you reduce your tax rates over the long period of your retirement, therefore keeping more of your retirement savings, more of your money, more of your income with you versus giving it to the IRS. I hope that you've enjoyed today's video on how to keep more of your hard-earned retirement savings with you versus paying it to the IRS in taxes. That's a major focus for us and for our clients. And if you'd like more information on that, don't forget to subscribe to our YouTube channels. We're coming out with new videos each and every week on topics like that, as well as topics on Social Security, required minimum distributions, and other retirement planning topics as well. So don't forget, subscribe to the YouTube channel. That way you get notified when we come out with those new videos. Thanks. Have a great day.